Is it at least safe to say that the market melees that we've seen over the course of the past 5 or 6 days or so has now resolved itself? Are we now pretty much clear to get back into risk assets?
Well, I'd like to think happy days are here again, but it's just going to take another headline or a news blip to upset that. But what we had Sunday night was Jerome Powell giving the stock market a nice big hug and saying, hey, the economy is strong and interest rates are okay and we're in a safe place from a rate perspective. Remember, what really hurt Q4 in 2018 was the Fed. And there was Chairman Powell talking at length over and over saying that interest rates he's comfortable where we are, and he took away any hint that there would be a rapidly escalating rate move or further tightening with QE. So I think that's the underpinning for this, and I think that's going to be the story in 2019. There will be a lot of nasty headlines. There will be some stops and starts, some good news and bad news. But as long as the Fed remains accommodative and as long as the China talks don't blow up, I think we could have a mid-single-digit rise from here on out.
So, Mark, as we talk about the idea that the Fed and China are perhaps at least more in a holding pattern right now, are you still looking towards the health of corporate America as a driver for the market gains, if any, going forward for this year? We do know that earnings season for Q4 was pretty good, but the expectations have been coming down markedly over the course of the past few months for at least this current quarter that we're in.
Well, yes, and we've been expecting earnings to come down, especially in a year-over-year basis. Last year was a tremendous, rarely seen 20+% across the board in the S&P 500. So we expect a little leveling out, and we expect some good news and bad news. We saw that in the retail sector. Some companies like Walmart blew out and others didn't. So I think we're going to see a continuation of which companies are executing, who's delivering on their message. But overall, earnings growth is going to be slow and steady, and there's nothing wrong with slow and steady. We expect mid-single-digit earnings growth in 2019, and we think from here on out that leads to mid-single-digit growth in the stock market. So as long as earnings multiples stay similar, I think it's as steady as she goes. There's nothing wrong with that from a point to point from here on out with all the gains that we've had.
Mark, we've seen at least an interesting part of this recent rally that we've had, the recent leg. We've seen risk stocks, higher beta, higher volatility type stocks, perform decently well off the lows in December.
Right.
We've also seen defensive sectors do okay as well. So how does that resolve itself? I mean, are people still going to be seeking the safety of things like consumer staples and utilities and that sort of thing? Or are we going back towards all of those FANG names that we talked about before over the past couple of years?
I think interesting tech and the FANG group of stocks is here to stay. Regardless of their valuations, that's what's gotten people to the dance, and I still see money flows going in there. What surprised me is how the banks haven't really broken out here, and I think that could be a really great sign for the market if we continue to see what we saw early in 2019, where the banks coming off their lows. We have a strong economy, we have tremendously low loan loss rates, and we have banks that are not fully participating in this rally. I'd like to see that as confirmation that this rally could have a broad underpinning. That would give me even more confidence.